Namaskar and welcome to the first episode of Tax Concepts. I'm Dr. Pushpender Puniha. I'm a quintessential taxman and a raconteur of tax tales. I also have few academic pretensions, which are backed by the research team of the Taxmann Journal for these podcasts. I hope to engage with you in understanding the complex tax concepts in a simple language, in simple narrative. I laid no claims to answer all your queries, and I am no magical problem solver. But I hope to ignite in you a curiosity to explore the tax concepts. And our common goal is that we find some kind of solutions that reduce the cost of compliance of tax laws, reduce the anxiety that all of us face in complying with the tax laws, and ultimately lead to a greater peace of mind. All of us have heard of Bitcoins and cryptocurrency. My first two episodes would be dealing with the taxation of the virtual digital assets, VDAs as I will call them. As all of you know, the Finance Act of 2028 has introduced a 30% flat tax rate on the gains made on transfer of VDAs. Why is this topic of interest and significance? Most of us believe that VDAs are here to stay and they are the future. Few years ago, did you ever imagine that your vegetable vendor, the rediwalas of the Indian street, would accept digital payments, or that you would be conducting your banking from your laptop or even from your mobile? So the fintech, the so-called digital technology, is penetrating the financial transaction world in a manner which few could have imagined some years ago. And it is my belief that this movement towards digital currencies, towards VDAs, is based on very strong trends that are visible to all of us. These trends are not just digital or technological based, but these are the belief system of the younger generation. The younger generation believes, why should there be a monopoly of financial transactions in the banks? Why should I pay a huge arbitrage cost for financial transactions, which can be conducted far more easily and far more cost effectively through digital means, through data? So if the movement towards the VDAs is inevitable, then we better learn what really lies under it. And what better way to do it than to hear the voice of the masters. As our Indian tradition says, Guru se sab kuch seekhte hain, Baliari Guru aapne Gobindiyo mein laaye. Even our search of God is through a Guru. And what is the voice of the Guru in terms of VDAs? Let me quote the pseudonymous Guru of the VDAs, Satoshi Nakamoto, whosoever he is. It is only his pseudonym. And this master's voice says the following, that in the current world, and I quote, what is needed is an electronic payment system based on cryptographic proof instead of trust, allowing any two willing parties to transact directly with each other without the need for a trusted third party. So in simple terms, what Satoshi is saying is that if there is a willingness to undertake financial transactions among few individuals, where is the need to have a third party in form of a sovereign state, say in case of fiat currency, to intervene? When we can build mutual trust, we can impose mutual costs at each other. So the whole movement towards VDAs is based on cost effectiveness, on human motivations, and it is this inevitability which has been recognized already by number of nation states. As you know, the digital renminbi in China was introduced as a pilot project in April 2020. The Reserve Bank of India is mandated to introduce digital rupee in the current financial year. The so-called digital currency issued by central banks is on the agenda of every country practically. So this inevitability was recognized by the legislative wisdom of the Indian Parliament, and in the Finance Act 2022, they introduced the concept of virtual digital assets, the VDAs. So let's first examine the uniqueness of the definition of VDAs in subclause 247A of the Income Tax Act to understand what are our obligation if we deal in VDAs. And let me read for you the definition with a bit of explanation that is in subsection 247A of the Income Tax Act. The subclause starts as virtual digital asset means. Let me stop here. So what is the first learning point here? That the subclause 247A provides an exhaustive definition of VDAs. When in legal jargon we use means rather than includes, that means the legislature is providing us an exhaustive definition of what follows. So the definition of VDAs in the Income Tax Act is exhaustive. If we peel the legal jargon from the definition of VDAs in clause 247A, then we find that it essentially has 5 elements. The first is that it is an information or a code or a number or a token that has been generated through cryptographic means or otherwise. Or otherwise is an important phrase to note here. Now we know that cryptography is the science of protecting information by transforming any data or information into a secure format through the process called encryption. So cryptography and encryption are the essential elements of definition of VDA, and the phrase otherwise means that maybe cryptography or encryption are given any other name, but any kindred activity of the similar nature that gives rise to a information code or a number or a token would be included in the definition of VDA. The second element, which is important, is that the Indian currency and the foreign currencies are excluded from the definition of VDAs, and that includes the digital currencies issued by the central bank. For this purpose, the Act relies on the definition of currency under the Foreign Exchange Management Act, FEMA, of 1999. Now, there's an interesting offshoot of it. El Salvador introduced Bitcoins as its official legal tender and currency some time back. Would that make Bitcoins not a VDA? The answer is no. The definition of foreign currency under the FEMA would rule out Bitcoins as the official legal tender or foreign currency of El Salvador, and any dealings in Bitcoins would be included in the definition of VDA. The third element is that the VDA must provide a digital representation of value. It may be exchanged with or without consideration, that is immaterial. The fourth element is that there is a promise of inherent value, a store of value as well as a unit of account. This promise may not be provided by Reserve Bank of India or by any other central bank, but to be a VDA, the token or the information will have the inherent value and store of accounting elements written into it. And the final and the fifth element is that VDA must be capable of being stored, transferred, and traded electronically. So this definition of VDA is exhaustive and is very broad. It primarily excludes the fiat currencies of the nations. The only thing to remember here from my side is that only notified non-fungible tokens, NFTs as they are known in the common parlance, are included in VDAs. All NFTs do not become VDAs per se. An NFT is a medium, it's normally a medium of store of value for an image, video, or an audio, and they are created primarily in the fields of art, sports, and entertainment. But in future, the role of NFTs can increase, but in its received wisdom, the legislature as yet has made only the notified NFTs to be part of VDAs. So after considering this definition of VDAs, what is our broad learning point? My take on it is that if you deal with any virtual digital asset which generates a gain from you, please presume it to be included in the exhaustive definition of VDAs under the Income Tax Act and look for those exclusions. Can you fall in any of those inclusions? Then yes, you are saved from the tax liability. Otherwise, please go ahead and then declare it as part of your taxable income. And let me share from my experiential knowledge also that the data mining of all the VDAs would be very exhaustive by the government agencies. Any digital transaction that leaves an imprint which is potentially available to the taxman. It may not be available today because the technology has not reached the same level as some of the private players, but the government agencies will catch up. So you are leaving a permanent digital imprint, which potentially can be seen and caught by the agencies in sometimes in future also, and they have 10 years to reopen your cases. So my advice would be, whatever you think falls within this broad and exhaustive definition of VDA, and you have made gains from it after 1st of April 2022, please include it in your income. This brings us to the machinery provision of computation of income arising from transfer of VDAs. This is provided under Section 115 BBH of the Act. At the outset, please remember that 115 BBH is not a charging section. It is a machinery provision of computation of gains and tax on VDAs. Income as well as tax on transfer of VDAs shall be subject to substantive charging provisions, which are sections 4, 5, 9, and 14 of the Act. And this interplay of the machinery and the charging provisions give rise to very interesting questions of law and fact. But before discussing that, let's first discuss the machinery provisions of 115 BBH. When and how does the transfer of VDA becomes a taxable event? What are the processes which are involved in computation of gain and the tax on it? For these, we need to divide the events in the following broad categories. First of all, there should be a transfer of VDA, whether held as a capital asset or not. And the definition of transfer of VDA is as per the other provisions of the Income Tax Act. The transfer of the VDA should result in income, a positive gain. The third is the critical one. Such income or such gain which arises in my hands should be includable and chargeable in total income. And here, the chargeability under those provisions which I narrated before would come into play. And then comes the computation of tax on it. The tax on the income from transfer of such VDAs shall be calculated at a flat rate of 30%. Importantly, no deduction in respect of any expenditure other than cost of acquisition or allowance or set off of any loss shall be allowed in computing such income. So here is a very important provision that I cannot claim as deduction anything other than my cost of acquisition of the VDA. The next provision is also as important. It is that no set-off of loss from transfer of VDA shall be allowed against income computed under any provision of this Act. So I cannot say that I have earned a loss on transfer of VDA and claim it as a set-off. The next provision is also nearly as harsh, and it is that no loss shall be allowed to be carried forward on transfer of VDAs to any succeeding assessment year. So in nutshell, what it says is that if you make any gain on the VDA, it shall be charged to tax at 30%, and the computation would include only the cost of acquisition. No loss made on it would be allowed for set-off against any income in the current year or in the succeeding year. Now let's come to at least one question of interplay of the chargeability of the sections and the machinery provisions of 115 BPH. The income tax jurisprudence is primarily based on two principles. It is the residency principle, as we know, and the source principle. Given these principles, the situs of VDA becomes the critical point. And situs of an intangible asset, like a virtual digital asset, is a very complex question. The accepted international practice is that situs of the owner is the closest approximation of situs of intangible asset, unless and until it is altered by the local legislation. No such provision exists in the current Indian legislation, and this would open opportunities of tax shifting. It is my opinion that the current legislation would even lead to that intangible asset of VDA may be developed in India, it may be commercially used or exploited in India. Still, the income arising from their transfer outside India would not be brought to tax in India. The amendments which have been brought in Section 5 after the Azadi Bachao Andolan case, or as well as the Vodafone International case, would not be applicable ipso facto to the VDAs because they take into account only the transfer of shares of assets that are located in India. So it is my submission that if leakage of revenue is sought to be plugged, then certain amendments would need to be brought in the Act. This is a good place to lay out my basic values of sharing my thoughts on the tax concepts. I believe that every penny and every rupee of tax must be paid, not a penny more or not a paisa less. We should pay, and we ought to pay what is my legal obligations, and no more needs to be paid. And the tax should be collected in a manner in which a bee collects nectar from the flowers. The bee does not damage the flowers. Instead, it carries the pollen from one flower to the other, and it makes the garden bloom. This concept I have borrowed from Kautilya's Arthashastra. With these few words, I'm ending my first podcast with the hope that you would join me in my next podcast after a fortnight, where we will discuss the specific issues which arise on transfer of VDAs, the computation of income, as well as computation of tax on it.